Welcome to Trade Talk, weekly market update. As we had mentioned earlier, our view on the Nifty 50 remains positive. On 22nd April, Nifty made a top around the 24,550 level, and since then, the market has been forming a proper double top structure. After that move, we had clearly mentioned that there was a gap between 23,200 and 23,600 zone, and Nifty was likely to come down, fill that gap, and then reverse from there. We shared this view across our WhatsApp groups, videos and audio updates. From there, Nifty made a low near the 23,262 level. And exactly as expected, the reversal started from the 23,200 support zone after the entire gap was filled successfully. At the same time, Nifty Bank also filled its April gap between 53,200 and 53,500. And our 55,000 target for Bank Nifty has been achieved. Looking ahead, Bank Nifty now appears to be moving towards the 57,000 to 60,000 zone. Our strategy between 23,200 and 23,600 was clear. Deploy available funds and continue building positions in quality stocks within that range. From here, we believe the targets can extend further. Now the bigger focus is shifting towards the sector and stock selection because the market is currently being driven by a few major triggers. The first major trigger remains the ongoing trade discussion between Iran and the United States. There is a significant pressure on the Donald Trump's administration to resolve the issue quickly, as this uncertainty has continued for nearly 3 months. And it has started impacting inflation and the overall market sentiments. However, our view remains positive because if the Iran-US situation gets resolved and the trade routes begin normalizing again, crude oil price declines sharply. If crude falls below the $90 zone, it could eventually move towards the 70 to 80 range, and even before that happens, markets are likely to react positive. That is why we are closely focusing on inflation sensitive sectors and stocks. Companies like Hindustan Petroleum, Berger Paints, transport related companies and FMCG stocks could benefit significantly once fuel prices start cooling down. As fuel price stabilize, consumption and buying activities are also expected to improve. Over the last week itself, petrol prices have increased by nearly 7.5 rupees, while CNG prices are also moved higher, which is creating additional inflation pressure in the economy. At the same time, the government is fully aware of the situation, and this becomes the second major trigger for the market. There is growing expectations that the government may consider some relaxation regarding higher SDCG and short-term capital gains taxes, especially after the pressure seen in the market over the last few trading sessions. There are also expectations that the taxation on gold selling could be reduced so that gold prices remains under control and overall market liquidity improves. At the same time, we continue to closely monitor crude oil because India remains heavily dependent on crude imports, and crude will continue to influence inflation, transportation cost and FMCG demand overall market direction. So overall, our market view remains positive and our focus continues to remain on quality stock accumulation and sector specific opportunities.